Welcome back. Let's invite the management of Century Ply. Keshav Bhajanka, the executive director of the company, is now with us to talk about how demand is looking right now. Mr. Bhajanka, thank you very much for joining in. This is typically a strong period for you, right? Post-Pujo, pre-Diwali. Could you give us a sense of how the volumes have been and even the price action compared to last year and even say pre-COVID? How would the numbers look?
I think, last quarter has been a good quarter, considering the high base that we had in the previous year. Q2 last year, there was a lot of pent-up demand, and as a result of that, we got a very good, we got good traction from the market. I think this year we have performed quite well, considering the market scenario. There was inflationary pressure, as you know, raw material prices were high. That led to price increases right across most product categories. But I think despite that, the demand scenario on the ground remains extremely buoyant, and we are expecting better growth towards H2 as well.
Okay. Could you give us some numbers? How much better compared to last year?
It'll be difficult to give numbers, but yes, it is definitely better than last year.
All right. Hi, Keshav. Good to hear that demand is solid on ground. Give us a couple of numbers then on the pricing front. I understand that, July was a bit of a subdued month on demand. Now, we have raw material costs as well that have cooled off a little bit. So, did you push through any price increases in the past quarter, or was it as flat as can be? That's point number one. And given that the second half of the year is likely to be good for the year FY23, what kind of a growth are we looking at in comparison to FY22? I think we were flirting with mid-teens earlier, right, in terms of a top-line growth?
I think we are definitely looking at good growth for the current year. We were looking at 15% plus growth for the year, and I think we are more than on track for the same. We should, in fact, end up with a slightly higher growth. Having said that, I think that with regards to raw material inflation, last quarter, there wasn't any meaningful increase in prices that were taken. Raw material prices have cooled off to a certain extent. Perhaps timber prices have not cooled off as much, or as chemical prices have. But I think that going forward, we will not be in a position, we will not need to take further price increases. In fact, the margin profile should start improving as raw material prices cool further.
Just on margins, so because of the unfavorable base, will margins across segments be higher? Can they be higher on a year-on-year basis?
I think, we have given a margin guidance, which is 13 to 15% for plywood, 14 to 16 for laminates, and 25% for MDF and particle board. And these are the long-term sustainable margins. Definitely, the attempt will always be to look at higher margins. But going forward, I think these are the margins that look possible in the long term. Over the course of the next 2 quarters, definitely the margin should be slightly higher as compared to earlier in the year due to raw material prices cooling off slightly in plywood and laminates. MDF and particle board might still see some raw material price inflation due to the high price of timber, particularly in the north. But I think we are more than equipped through price increases to cover the same.
What would be the net decline in your raw material?
I think, in chemicals, there's likely to be a stark decline because prices had shot up drastically. So compared to, say, quarter 3 of last year, quarter 4 of last year, there could be a 30-35% reduction in the price of chemicals. But there has been an increase in the price of timber, particularly in the north, which is in excess of 10, 12, 15%. So that impact is likely to negate some of the benefits from the reduction in chemical prices.
12% price increase, that is in quarter 2 in comparison to quarter 1. I recall in quarter 1 it was up by 5%.
No, it is a gradual increase which has taken place over time.
Over 6 months?
Comparing it to last year. Yes, over 6 to 9 months.
Over 6 to 9 months, it's up by around 10 to around 12%. The street as well was a little cautious. Why timber prices? There was a difference between North and South India as well. You're telling us that North India is the problem out there. Give us a greater sense on MDF then, Keshav. You have some capacity that's coming on stream. So how is the industry dynamics playing out here? Since that's going to be the growth driver, that's going to be the margin driver as well. What were the imports a few months ago? Are you seeing a resurgence in terms of imports? I want a sense on that business.
Well, I think it is one of the growth drivers to begin with. We are we are bullish on growth across segments, like I've mentioned before, whether it is plywood, whether it is laminates, whether it is particle board or MDF. But yes, it is likely to be one of the larger growth drivers. Imports have definitely gone up to a certain extent, because shipping costs have fallen. But while shipping costs have fallen internationally, the price of MDF has shot up. The price of MDF has increased by 15 to 20% in international markets, and that is helping the case for domestic manufacturers. In the north, we are not facing any challenges with regards to imports or any meaningful challenges with regards to imports. The new capacity that we are coming up with is in the north, and I think that going forward, that should not be a challenge at all. In the south, import pressure is likely to be there, and long term, this is something that we will have to contend with as an industry. But having said that, the demand is extremely buoyant. We are looking at 15, 20, 25% growth in the industry. So, when you have a 20% growth in the industry, there is always scope for both import and domestic players. So we are not overly worried.
So you're saying despite the increase in MDF imports, there is no oversupply which could put pressure on MDF prices which hurt your margins? Is that what you're saying?
Yes, there are two facets to it. Firstly, the demand growth being robust gives all of us a chance to increase our capacities and at the same time to be able to utilize those capacities. Other than that, the import prices, base prices, not taking into account freight, which may have fallen, compared to earlier, they have gone up. So both of these put together put us in a position where we are able to maintain margins, perhaps not as high as Q1, which you saw, that could have been an exception, but around the guidance that we have given of 25% plus, I'm sure we should be able to maintain the same.
All right, Keshav, in the personal capacity, the promoter entity has gone ahead and bought a large stake in Rushil Decor. Nothing more we should read into it, right, from a listed company perspective?
No.
Or is there a plan out there?
No, there's no plan. It just looks like a very good company at an attractive valuation. That's it.
But nothing from a listed company perspective? It's going to be a personal investment itself?
Yes, it is a personal investment.
Okay.
All right, Keshav, thanks very much. So next time you're on, questions will be on your business and Rushil's business as well. Thank you very much. Appreciate it. Well, that's Century Ply. 55 points lower, so things are, down but not out. It's not going one way. And the problem is IT services. IT services index is down 1%, full 1%. There are 10 stocks in the Nifty IT index. One is positive, 9 are pulling in the other direction. The one positive, of course, is HCL Tech, and the 9 others are all down and out. Wipro, LTI, TCS, and Persistent are the 1% plus losers. Wipro, of course, is down the most with about a 5.5% cut. We'll take a quick break here. We'll come back, when we come back, quarter se quarter tak, we take stock of the auto sector preview for the second quarter. We'll have Rishi Vora, Associate Vice President of Kotak Institutional Equities, who will be... I think Rishi is with us now. Apologies for that. Rishi, great to have you with us here. Rishi is Associate Vice President of Kotak Institutional Equities, tracks the space closely. Rishi, set us up, set the sort of context for us, in terms of how we should look at, or rather how we should approach Q2 for the auto space, and segment-wise. Passenger cars and two-wheelers.
Sure. Good morning. Again, looking into 2Q, YOY numbers will not be comparable because last year the sector was impacted because of supply shortages. So more from a QOQ perspective, sequential perspective, the segments which has done well is domestic PV and domestic two-wheeler segment. PV segment, have seen a double-digit kind of a sequential growth, and that is majorly driven by improving supply chain as well as some channel filling before the festive. This time around Diwali, we have an early Diwali versus last year. So in this month of September itself, there has been some channel filling. that has helped the wholesale volumes. Two-wheeler also, a few OEMs were impacted in first quarter of FY23 due to supply shortages again. And that is again, result this quarter we have seen that improvement, and obviously channel filling before the festive will also has resulted in double-digit growth. So a decent, we have seen a decent growth in domestic two-wheeler and a PV industry. However, on the export two-wheeler side, there has been some pressure, especially in African geography because of very high inflationary pressures and obviously a dollar strengthening that has resulted in overall weakness in the export two-wheeler market.
Rishi, what are we expecting from Tata Motors this time? Because the JLR retail numbers were disappointing. There are concerns about US, Europe, where JLR has a great presence. Though in India things are fine, it's riding the EV boom, but it's impacted by what's happening globally. What's the expectation this time from Tata Motors?
Yeah, so obviously the company had guided for Q2 volumes of closer to 90,000 post the first Q announcement of results, but they actually reported 75,000 units. So it's much below what they had guided for, and that was mainly because again of persistent supply situation. So volumes nonetheless were on the disappointing end. But on a sequential basis, we do expect that margins will see an uptick from where it was in first quarter. Mainly, two reasons. The model mix would be favorable this quarter around with a higher Range Rover Sport models, and also the Chinese market has done well for them, which is again a margin accretive market for the company. So overall, we expect them to report a flattish EBIT margin versus a negative 4% EBIT margin last quarter, but nonetheless, volume trajectory still remains a little bit on the disappointing side.
Hi Rishi, what about the two-wheeler space in particular? Eicher Motors, talking about volume pickup, that's delivered the best volumes in September.
Yeah.
What's the view on the stock from here on? And if you could give us some more color about your current stance.
Yeah, sure. Again, the new launch Hunter 350, at least in the last 2 months, has been very well accepted by the market. The inquiry level still, remains at a very healthy levels. From this quarter perspective, one thing which we will be tracking closely is, how given that given that Hunter 350 would be, lower ASP product for the company, margins may come under pressure for the company. So from that perspective, we believe that despite the operating leverage benefit, margins for the company in this quarter may not see a material, increase from that perspective. So overall, export mix is also weaker sequentially. Higher Hunter mix will also weigh on their overall profitability. So volumes, they have done exceedingly well, but on margin fronts, we believe that may remain under pressure in the current quarter.
Right. In terms of the overall sector, which are your top overweights, Rishi, right now?
So again, valuation of the sector remains a little bit on the higher side. So for companies which we cover on FY24 basis, the sector is trading at closer to 21 times FY24 EPS, which is still on the higher band. So we have a very, very limited ideas in the sector. So we'll be overweight M&M and Ashok Leyland on the OEM side. And on the auto Eng side, we like Sona Comstar. All right.
M&M, Ashok Leyland and Sona Comstar, valuations a little uncomfortable at about 21 times FY24 earnings. So needs to cool off a little bit. Thank you very much, Rishi. Great to have you with us here. And appreciate you running us through what you're making of the sector as we go into the earnings season. 72 lower now, so right there, 60-70 point cut since the morning. I mean, the low to watch would be around 19,650 or 19,650 or so, and that is basically the low that we. Sorry, 16,950. I mean, Nigel, the levels are coming and going so fast.
The bulls have been dancing. 19,000 odd, we haven't heard that for a while, but let's hope it's due.
Yeah. What did I say?
19,650.
Oh, wow. That'll be the day. Yeah, the low yesterday and day before is pretty much the same, 10-point difference. It's 16,960 yesterday and 16,950 the day before. So in that range, which is about 100 points away from where we are right now. We'll take a quick break here. We are back. Mitesh Thakkar is with us with some technical trading ideas on the other side. Stay with us. Okay, welcome back. 60 lower at 17,000 and 60 IT is the problem. As I said, 9 out of 10 stocks in the IT index are lower. The lone survivor is HCL Tech with still a 2.5% gain. Mitesh Thakkar is with us to run us through, fresh thoughts, fresh trades, if any. Mitesh, over to you.
Yeah. Prashant, on the index, I think, nothing has changed. You did, mispronounce the level, but I think 16,950 is the key level to watch. And as long as you're above that, I think, we're not falling down. So trading is stock specific. I have one buy and one sell. India Mart is something which has come on the buy radar after a long, long time. That's a good breakout on the intraday charts. So buy here. Keep a stop at about levels of 44.90 and target around 46.50 on the upside. While IRCTC and disclaimer, I actually have this in my long-term portfolio. That's a sell call for the short-term trading. Keep a stop just above levels of 727 and look for target of around 685.
What's the long-term target on IRCTC since you have it in your portfolio?
Yeah, I just gave a disclaimer, but I have a sell call in the short term.
Oh, sell call. So, okay.
Yeah.
All right. Thank you, Mitesh, for joining in. Let's also shift our attention to the commodity markets. Manisha is back with us. Manisha, what are you tracking?
Well, thank you for that. I'm looking at the aluminum prices where we did see 5% of gains in the overnight market, but they have not been able to sustain there. But we'll talk about the price volatility as well, because, when you look at the overnight markets, at one point in time, the aluminum prices were up by 7.3% as well. And we did see $2,400 per ton. As of now, it's trading at around 23860 on the LME markets there. As I said, it has been a volatile aluminum market. We did see a 17-month lows in the month of September, and we closed that month 7% on the lower side. When you look at October until now, we're up by nearly 4% there. This is the aluminum range that we've done in 2022 until time. We did see an all-time high of $4,100 per ton. We've done a low of $2,100. At this point in time, we are trading at $2,360 per ton. So we are trading on the lower side of the range. And from these highs, from these all-time highs that the aluminum prices have hit in this year, we are still down by nearly 43% there. Markets are looking at the latest trigger being the US planning to raise tariffs or completely ban Russian aluminum imports going forward. This is a conversation until now. And let me remind you that until now, there has been no ban or suspension or sanctions on any of the metals from Russia. Now, Rusal is in focus, and which is the world's largest aluminum producer outside of China. We do understand that Rusal contributes nearly 6% of the global aluminum. And last year, the production from Rusal was 70 million tons as well. The other factor that the markets are watching out for is the LME, which also has issued a paper suggesting that they will stop or suspend all new deliveries of Russian metals onto their exchange for trading and for delivery purposes as well. That clearly has been adding premium to prices too. But the reason that these gains have not been sustainable, one, you have China, which is persisting with its COVID policies, the strength in US dollar index at 113, demand concerns from Europe and China as well. And then the markets also are awaiting the US inflation data today. Chinese inflation and Chinese trade data numbers come in tomorrow as well. So the next couple of days rather, are going to be quite eventful.
Okay, thank you very much for that. Let's talk a bit about Wipro, because that is the big loser. The stock is sold off close to about 5.5%. Q2 numbers were in line with street expectations, but the worry is on the second half outlook. The company's Q3 guidance at 0.5 to 2% revenue growth has come in softer than street expectations. Secondly, the company is also not building in margin improvement. Remember, margins for Wipro at close to 15% are at a decade low. And even in Q3, it's not that margins are going to rise from current levels, because there will be a wage hike impact. So the street is also a bit unclear about the margin improvement trajectory of Wipro. So, which is why today when we spoke to Sandeep Agarwal of Edelweiss, he said that I've brought down my margin estimates for next year as well, because he was earlier anticipating margins to rise to say 16.5%, but that now seems unlikely. So that's the big disappointment coming through on Wipro, that on revenues, the Q3 guidance is a bit subdued, and two, the management commentary did not give you confidence or is not giving you a trajectory of margin improvement from current levels. But on the flip side, HCL Tech's earnings are looking good and the stock is being rewarded in today's trade. Q2 in line, revenues were in line, there was a margin beat, so margins expanded by 100 basis points. Their deal wins were strong, so that should allay concerns in that the market had, that because of the demand environment, deal win run rate could slow down. In the case of HCL Tech, deal wins were up 16% on a quarter-on-quarter basis. And the strong deal win run rate has given the company confidence to go ahead and raise its full-year revenue growth guidance. And this came in as a big surprise. They've tightened the margin guidance, but it doesn't change the actual estimates in the street, because anyway, the street was penciling in margins for HCL Tech will be closer to that 18% mark. The earlier guidance was 18 to 20. Now they're saying it's 18 to 19%.
All right, Rima, I'm tracking a few stocks, and the aluminium bulls will be very, very happy. Remember, aluminium prices have seen a sharp correction from the top, and now overnight was up by around 5 to around 6%. Or it could be another problem for inflation if it sustains at these levels. But let's run you through the news point. Well, reports suggested overnight the United States was considering a ban on Russian aluminium in response to the conflict in Ukraine. Now, Russia's Rusal accounts for close to around 6% of the global production. And remember, ex of China, this is the biggest producer of aluminium. The stocks in focus will be Nalco because of its direct link, Vedanta as well because part of its business is linked to aluminium, while for Hindalco, only their domestic part of business is linked to aluminium prices. Remember, this happened earlier as well in 2018. At that point of time, aluminium prices surged up by close to around 30% once the sanctions were imposed. The problem is that in 2019, the US itself realized that this is unsustainable and they pulled back the sanctions. And that's why, in fact, Rima, we did see that prices corrected from there. So a tricky situation, but for the time being, the street is factoring in higher aluminium prices.
Okay, with that, we're going to take your leave on Bazaar. We leave the markets a little lower than what they were at the start. So currently down about 0.5% on the benchmark indices. The mid-caps too are struggling a bit. The advanced decline ratio has 2 stocks in the green for 3 in the red. Time for a break, but on the other side, it's our special segment. It's the economy. Lata will connect with Samiran Chakraborty, Chief Economist, India City, and former Monetary Policy Committee member, Mridul Sagar. He is also IEPF Chair Professor at the National Council of Applied Economic Research to decode growth, the inflation data that came out yesterday.
The inflation data we got yesterday was a little higher than estimates, and the industrial growth data was a little lower than estimates. Nothing dire, but this is not a happy combination. What was more painful was inflation was pushed up by food inflation running at 8.6%, with the 2 most important ingredients, cereals and veggies, rising in double digits. On the industrial growth front, the most painful number was consumption. Consumer non-durables actually contracted by 10% this August compared to 1 August ago. To assess both growth and inflation numbers, I have with me 2 perhaps of the foremost economists in the country, Mridul Sagar, the IEPF Chair Professor at NCAER, and more importantly, former MPC member, and Samiran Chakraborty, the Chief Economist at Citibank India. Gentlemen, thank you very much indeed for joining me. Mridul, let me start with you. The CPI is only 10 basis higher than what the street was expecting. But like I pointed out, food at 8.6, core still running at 6.1. Is the Reserve Bank's trajectory of 5.8% by March under danger? Do you think it won't get there?
As of now, no, Lata. I think RBI projections are pretty realistic. So, in fact, this quarter average is 7 vis-a-vis 7.1 estimated by the Reserve Bank. So I don't think the numbers are at threat. But irrespective of the numbers, I think what is important is the momentum is staying. And the momentum in October at 0.57 month-on-month increase in CPI index is above the average for the September we normally see. If you see the pre-pandemic, it's like more like 0.34.
Oh.
So the momentum is high. Inflation expectations as per the RBI's latest survey are climbing. So you can't really relax the vigil on inflation in these circumstances, and you need monetary policy to control the second round effects. Any sort of impact on inflation expectations might come in more generalization. The generalization numbers which I'm seeing, it climbed up quite a lot in April, but then a little bit has receded, is higher across commodities, and is staying put between October and September. No material difference in that.
Okay.
So this is how I'll react.
Okay. Samir, a somewhat similar question to you. As Mridul pointed out, even that worried me. The month-on-month inflation running at 0.6% in September over August. Now, October, again, the delayed withdrawal of monsoon, late rains. Do you think we are in for persistently upside surprises or shocks in inflation? Are you changing your numbers in the first place?
So, Lata, just to take forward the point that Mridul was mentioning, I'm more worried that the persistence is there on the core inflation side rather than the headline.
Oh.
The core inflation month-on-month changes are practically getting cemented around 0.5%, which is annualized 6% for CPI, and doesn't look like that the effect of monetary policy is being felt at all, even on the core inflation number. But I guess the upside risk is going to come from these unseasonal rains and something which is brewing, which is the high increase in fodder prices.
Oh.
And it can fit into the component of inflation on meat, eggs, etc., which was relatively benign till now.
Yeah.
This high fodder prices can feed in there. And the last risk that we have highlighted is that the services inflation, particularly contact-based services, was receding in the last few months. And suddenly in September, we have seen again an uptick in that number. It could be because of festive season demand, but if it is more sustained, then this will be another upside. So altogether, we have put a view of about a 30 basis point upside risk to our current projection of 6.7% for the full year, which is similar to RBI's projection. But that 30 basis point is mainly going to come from food, fodder, and services.
And it is not a small number. I mean, that pushes 6.7 to 7. So it can be uncomfortably high. I'll come back to inflation, time permitting. I'm actually worried about the growth number as well. We don't lay great store by IIP, I would assume. But the contraction, 0.8, consumer non-durables contraction by 10%, seen along with the PMI number for September also, which clearly receded. How would you look at growth, Samir?
So, Lata, actually, you were right that normally we don't talk about IIP as much as we do CPI. But this time, this has caught even my attention. If you look at it, this is the fourth consecutive month of month-over-month decline in the IIP index, which shows that there is something which is slowing down. And what is confusing is that if you look at some of the other high-frequency growth indicators, they are not showing that kind of sluggishness. At max, we can say that our high-frequency combined indicator is getting flatlined rather than falling, whereas IIP is showing signs of
even
falling.
Even core did, right?
Exactly. And what was also interesting was that the consumer non-durables fell much faster than consumer durables, which is in line with our general understanding that rural demand is more sluggish compared to the urban demand. That's where it shows up. And even the investment side, the capital goods component has started falling, whereas our investment indicator from other high-frequency growth data seems to be more flattish rather than falling. So IIP is signaling something which is slightly different from what other indicators are showing, but it could be a harbinger of saying what we analysts are factoring in, that in the second half of the year, growth would be relatively slower compared to the first half.
Okay, Mridul, I would want your view on that. You know, another number which we didn't report enough, but Soumya has said it in his report, Soumya from SBI, capital capacity utilization. In Q4, the governor even read out the number, said 75.3. The latest Obicus survey is saying 72.4. Overall, same question. Is growth getting tired?
Now, as far as capacity utilization is concerned, once you seasonally adjust the numbers, they are above the trend. So, per se, it's an ideal situation where more investment can kick in. But will that happen given the uncertainties which are unfolding globally? I think people will wait and watch before putting in money on the investment table. So, that could probably what Philip the growth could have got from investment side. We still have to wait and watch how that can come through. But there's absolutely no doubt that the growth is slowing down, and there is reason for it to slow down. I mean, we are seeing synchronous monetary policy tightening across globe. Financial conditions are tightening, and they have sizably tightened, and emerging markets are facing the brunt now. So growth has to slow down. I mean, I would expect it next year to be closer to 6, slightly above maybe, but there are downside risks also. So this is the environment we have to live with, and we have to complete the task of soft landing from the monetary policy side, bring inflation under reasonable control. That's the only way the macro will work.
Oh, FY24 growth, RBI only gave us Q1 and I think they put it at 7.2 or something. Samiran, FY24, Nomura has a 5 handle, I think 5.2 if I'm not mistaken. Your number, and have you lately brought it down?
Lata, for FY24, we have it close to 6, just a tad lower than that at 5.9. But the challenge really is that the global growth outlook itself is extremely uncertain now. We are talking in terms of more scenarios rather than having just one forecast for the global outlook. Or global economists have put out even a hard landing scenario possibility where global growth could fall to 0% as well. Under those circumstances, we might have more downside risk to the India growth forecast as well. Because this time around, even if the global economy slows down, the kind of support that you have normally seen global central bankers doing QE and that helping capital flows into India and India's asset markets, etc., that channel might not be very dominant this time around, which leaves us with the negative effect from the export side affecting our growth in FY24.
Is that the only impact, Samiran? I mean, of course, exports have already started showing that impact. But, I had an interview with Raghuram Rajan yesterday. The UK gilt issue, pension funds over-leveraged and therefore unraveling when interest rates go up very fast. There seems to be a financial instability issue, not just in EMs, but developed markets like UK, even Germany. There were some pension funds which have this leverage issue. Just your thought on this whole financial instability problem in DMs and whether there can be ripple effects of any kind on the real economy in India.
Lata, we are living in uncertain times, to say the least. Sorry, is there a question from Mridul?
Yes. No, it's for you, Samiran. Go ahead. I will go to Mridul.
Okay. Sorry. What I was saying was that, look, global interest rates are up somewhere around 400, 500 basis points, depending upon what you're looking at. Dollar is up 20% plus. Fed is talking about tapering its balance sheet by trillions of dollars. Under these circumstances, shocks to the financial market is a real risk that we have to acknowledge. But as economists, our problem is that we cannot make growth forecasts based on expected shocks. That's quite difficult. So if something happens to any UK market or any other global market, we have to respond to those events in our growth forecast at the best. But it's difficult a priori to start factoring them into growth numbers. What we can factor in is only the global growth slowdown and its consequent effect on the Indian economy. Apart from the export channel, I think the other channel which Mridul was mentioning is that investment uncertainty leads to capex slowdown. So that process can get further extended if the global slowdown continues.
Okay. Mridul, I'm running out of time and I'm going to ask you some unfair set of questions. One, your comment on this financial instability in a word. How will RBI look at it in terms of external sector, etc.? And secondly, now MPC has to write that letter to Parliament explaining why they failed. Is that a pressure on the MPC? And will that make them borderline more hawkish?
So I don't think they will borderline would cause them to turn hawkish. I think they can explain the sort of breach which has occurred. In today's world, practically every inflation targeting central bank is facing that. So, as I said last time, I think what is very important is we should not attach a stigma to that breach.
Okay.
What is most important is how credibly the central bank explains the reasons for the failure, the time period it will take to come back to the target, and the steps it will take in order to lower the inflation towards the target. I think that path would be very critical. I'm not sure it would be in public domain. As per the rules, they have to write a letter to the government, and then one has to see how the process takes place from there.
Okay.
So one has to wait and see on that aspect. But yes, on the financial instability, I think what Samiran was saying is absolutely the crux of the matter, and what you have been pointing out in your discussions with the Professor Raghuram Rajan yesterday, that also revealed a lot. So clearly, as I said, it's a tip of the iceberg, what we are seeing now. And though the good part is that the global financial regulatory reforms post-global financial crisis have made banking sector resolute, relatively resolute at least. And what we need to see is how the shadow banking sector, now no longer the term is used, the non-banking financial intermediaries respond to this liquidity tightening, and whether there are network effects which will become very prominent. And I believe there are a lot of strong network effects which are there as the hidden leverage, which people have been pointing it out.
Yeah.
So RBI, to my mind, needs to remain focused on macro financial stability. I think we should stop debating too much on the inflation and growth numbers.
Okay.
This is not the right time to worry about those things. Growth will come automatically once macro stability is ensured.
Absolutely.
But growth can get derailed if macro financial stability suffers. And there could be trigger points in near terms also.
Yeah, I take your point entirely, Samiran and Mridul. Thank you very much for an extremely enlightening discussion. They are more worried about inflation and more worried about growth, but really now you can't take the eye off the financial stability ball, especially with UK pension funds once again being reported to be selling bonds because of the fall in prices. I mean, it's financial stability that is going to be core for decision makers. Wrap up on Bazaar. Trading ideas coming up for you on Chartbust.